Hello, welcome back again. Let's take a look at Tencent Holdings. This was also suggested by one of our subscribers, a company that I have taken a look at maybe a couple of months ago. It's been a while, and it's a prime opportunity to look at it because it's been going down along with the Chinese stock market, of course. And we want to see whether all this downtrend can potentially yield an interesting price to us, an interesting price to pay to retrieve some of this stock for our portfolio. So let's see what's going on with this one. In the last 3 years, as you see, the stock price has been going down pretty much since 2021. This is December 2020 actually. It had its good days and actually reached its peak at February 10 over here, and then it started going down. So it's been in a pretty much downtrend for a long time now, down almost 50% from its highs. Let's see how it's doing financially though, because that's what we care about. The P ratio here, look at this, from 50, it's actually gone down to 11.8 in April. This is April, pretty much this month. And so this is 11.8 and the price to free cash flow ratio 15.2. So this is amazing. And the outstanding shares is the only red one here, the only X. But it's 2% higher, and this is why I have included the percentage here. Very, very important to know how much it has increased. So 2% in 5 years, I'm fine with this dilution. This is not too much, so I'm totally fine. This is almost a green to me. Although I would like them to buy back some shares, to tell you the truth. At this price, it looks like it may be a good price. Although we will examine that using our stock evaluation tool a little bit later. It may not be. The free cash flow to total liabilities ratio 4.2, meaning that we need the 4.2 years of last year's free cash flow to pay all the total liabilities that the company has. A very, very solvent company. So this is important to know, to know how much debt the company has and liability. So to deduce whether it's actually easy for them to repay everything if they really wanted to. Of course, they're not gonna do it, but it's a measurement. It's a measure to know how easily they can do it if they wanted to. So the 5-year revenue growth, look at this, 140% here, more than doubling in their revenue here, and more than quadrupling their net income in the last 5 years. Insane increase here. Actually, a little bit less than quadrupling, but close to that. 35 billion to 10, from 10 to 35, 3.5 times. So, 5-year free cash flow growth, 140%, 223 the total equity growth. Pretty great growth for the company here, doing pretty well. Not much debt here, less than 1 is what we want to see. It used to be a little bit better as we're seeing here, but still it's less than 1. They took a little bit of debt, a little bit of extra debt it looks like. Current ratio of 1.2 is our borderline good value here. 1.2 is the value that we want to be seeing, an upwards that of course. And look at this margin, it's pretty awesome over here. And look at this return on capital employed and return on equity. Amazing numbers here. I love this. Very, very nice business to be part of. Now, interesting thing here. Take a look at this dividend yield is 4.2% for the company. But look at the payout ratios here. They seem very elevated. The reason for this is actually a special dividend that the company paid. And this is a one-time thing, and it's not really reflected here in this dividend stub so far. It's something that I'm working on, because these kinds of special dividends can really skew the payout ratios. They happen all of a sudden, and it can be difficult to track everything for every company. And what I'm doing right now to solve this is I'm actually creating a separate dividends history module, which will actually tell me exactly what has been happening with dividends, and actually show me a history of the ratios and everything. That's gonna be amazing to know exactly what the company is paying and they have paid through the years, and actually easily see whether this kind of payout ratio is a one-time thing or it's just happening for pretty much perpetuity. And so right now the actual dividend payout ratio, if we're taking a look at the regular dividend that they're paying, is much less. It's like 5%. I think the FCF is like 15%, the dividend payout ratio is 5%. But again, if you factor in the special dividend, this takes it that high. So this is actually a green, practically speaking, and it's not wrong, but it's actually taking into account the special dividend and not the regular dividend. And so I'm working on making a module that is going to be much more detailed and also look to exclude this kind of special dividends potentially, or have an alert really, which I think it's probably even better, just to tell you that there has been a massive change in terms of dividend payout ratios and all that. Lots of things that I'm working on in this tool. I think this one is going to be an interesting addition, but it's good to know about it. So this is a green as well. I wanted to point that out. And let's take a look at what's going on with the financial statements of the company. Starting with the income statement, you'll see a revenue growth of what was it, 140% or something, from 36 to 88 billion here, amazing. And net income that grew from 10 to 35 billion, amazing increase here for the company, doing amazingly well in terms of their bottom lines here. And what they're doing in terms of their assets and total equity here, 253 billion in assets and 115 in liabilities, bringing it down to 138 billion dollars. Remember, this is automatically converted to dollars. The tool automatically converts to dollars because this company is a Chinese company. It reports to Chinese one. And so, yeah, the tool automatically handles that and actually uses the currency exchange ratios back in the year that the reports were made. So this was in 2017. So there is the actual, USD to CNY exchange ratio back then in 2017 that's actually used for these numbers. So that's pretty awesome. Now, let's take a look at the cash flow statement. The net income, of course, has been increasing, but how does that translate to operating activities cash flow? Pretty much 21 billion here, 29 and 27. Company seems to be having some depreciation amortization pretty much every year. For some reason, we don't have these numbers. It can happen sometimes. But other non-cash items is minus 8 billion here. So the company seems to be having some payments here, some one-time payments. And okay, net cash by investing activities in the minus. So they have been investing here quite some. That's interesting to see. And cash from financing activities, some repayment here. Some extra debt over here. We did examine that they were taking some debt. That's not necessarily bad at all. If the company is making good free cash flow, I'm totally fine with them taking on debt. No worries at all. And from 11 free cash flow, 11 billion to 27. Great increase in free cash flow as well. So the company's financials look stellar, pretty awesome over here. But what is the company worth to us is the question. And this is what we want to examine next. The company's revenue has been increasing pretty much tremendously every year. And we have our handy table here, which we can very quickly use to add our projections. And we'll see that last year they did 16, but their average is 21 and 30. This is normal for it to go down as the company increases their top and bottom lines. They become larger. It's tougher to keep growing. It's not going to happen forever. And so we have to go a little bit more conservative. We're going to go 8, 10, and 12 here. Now, the net income margins are sitting at 30 to 40. So I'm going to go 30, 35, and 40 here. And free cash flow margins from 77 to 85. So I'm going to go 75, 80, and 85 here. And the annual return is 13% is what I typically want to make, because you can just make 10% from an S&P 500 ETF. You have more risk here, you need to be making more. Let's hit calculate. And as you see, Tencent right now is sitting at a very interesting price point. And frankly speaking, it may not be fulfilling our low estimates here, but frankly speaking, I think for me it is a buy. And the reason why it is a buy, even though the low estimates are not fulfilled, they are very close, so that's one thing. And also, I really love the company's financial numbers in terms of their returns. Like if you see here, look at this return on assets here, return on equity, return on capital employed, especially invested capital. I pay a lot of attention to these numbers, of course, and also the margins. The company is making fantastic margins, actually, that they seem to be increasing as well. So these are some very nice values here. The company has no debt. The dividend is very safe. I mean, things are looking pretty amazing. And I think this company is a buy for me. And I think that, you can't really go wrong. Even if you pay this value today, this amount today, and even if you are a little bit outside the low estimates that we used, I think that's very fair for what you're getting here. And it's still certainly undervalued based on what it is, I feel. So yeah, I think I'm personally a buyer of Tencent. I don't think it's as cheap as Alibaba, but I still think that it's pretty cheap. So yeah, if you ask me whether I would buy this one or not, I would. Yeah, definitely. So thank you for watching the video, and I hope you enjoyed it. Please leave a like if you did, and remember to subscribe. In the meantime, watch this video that I made earlier. In this one, I'm discussing Alibaba's balance sheet and how stellar it is and why. Thanks for watching. See you soon. Bye.